In a minute, just be patient. Could be the catalyst to trigger it. Francis Claro, co-portfolio manager of the Evergreen Global Opportunities Fund, joins us. Francis, what's behind your outlook?
Well, happy birthday, Liz. We've been a bit battered and bruised, but fundamentals are looking a bit better, and we think that's going to reassert itself in the markets.
All right, Francis, we'll talk more about that after the break. We'll be back. Our next guest says a kinder, gentler Fed should help soothe investors' worries, not just in the U.S., but also internationally. Joining us now from Boston to discuss this and other global issues, Francis Claro, co-portfolio manager of the Evergreen Global Opportunities Fund. Francis, good morning.
Good morning, Bob.
How interconnected are we now?
Well, first of all, I'd say one thing to look at is the euro and the effect that the U.S. has had on that. The euro has been strengthening because of the uncertainty in the U.S. elections, but also because of some more fundamental shifts, and that is the fact that the U.S. is slowing down in its growth and that the Fed is likely to ease. And the Fed is likely to ease before the European Central Bank. So that means that interest rate differentials between the U.S. and Europe are going to decline, and growth rate differentials are going to decline. So we think that the euro, on a fundamental basis, is going to continue to strengthen, even though, as the U.S. uncertainty regarding the election dissipates, we might have a short consolidation of the recent gains of the euro.
Okay. How high do you think the euro could go? Are we going to be back to parity?
It is possible that we could eventually go back to parity. Again, in the short run, we've already had some substantial gains from about 0.82 to 0.88. Some of that might be given back, but fundamentally speaking, the euro is undoubtedly cheap relative to the dollar, and we could trend eventually towards parity.
Is this because of a weaker American economy and a stronger European economy, or what?
Well, basically, it's just the trends in slowdown are different. The U.S. is slowing down from about 6% to maybe 2.5%. Europe is also slowing down, but a little bit more gradually, from about 3.5% to maybe 2.5%. So those very big growth rate differentials won't exist any longer. Inflation differentials have never really existed between Europe and the U.S., not substantial inflation rate differentials. So we're still seeing goods and services in Europe being quite cheap relative to the U.S., and that should eventually work its way into fundamentals.
Although I would guess the wild card would be energy, because it seems to have more of an effect on European economies than it does here in the U.S.
Right. In fact, and our view is that oil prices are definitely trended lower, even though in the short run we're in winter in the northern hemisphere, and that could sustain prices in the very short run. Lower oil prices should actually have a favorable impact, maybe a more favorable impact, in fact, in Europe, as gasoline prices are higher in the pump in Europe. So as oil prices come down, we're going to see a relief on consumers in Europe, and that's definitely should be compounding the effect of tax relief in Europe, and also of an eventual easing of liquidity in Europe as well.
All right, global opportunities, where do you see them right now?
Well, we see opportunities in, for example, playing a weaker euro, a stronger euro, and weaker oil prices. So, for example, we're looking at opportunities in the airline sector in Europe, where costs are denominated in U.S. dollars and the revenues are in euros. And we've seen a constraining in capacity, so seats aren't growing, and yet there's economic growth, and demand for airlines is still fairly strong. So that's one of the areas we're focusing on, and looking at some of the beaten down stocks as well that we've all seen happen, particularly in November.
And as far as countries are concerned, any particular ones you think are going to be strong?
Well, the UK should be benefiting from investor flows into Europe. Germany has had reasonably strong industrial production figures and has been benefiting from a weaker euro, and will benefit next year from tax reform. Italy and France are also benefiting from tax reform. So basically, we're looking at more of a diversified European strategy, but with some of the stronger countries, some of the larger countries doing fairly well.
Okay, thank you very much, Francis.
Thank you, Bob.
No one could be clearer than a man named Claro. Francis Claro of the Evergreen Global Opportunities Fund.
All right, let's be clear with